History and an MBA from National University of Singapore. He is a business transformation leader, grew through various roles and responsibility in Syria, Atlantic, and Hitachi Group companies in India and Asia Pacific through excellent financial governance, implementing financial systems, control and processes, channeling the organization resources to target and achieve financial KPI and OKRs over 17 years with an entrepreneurial mindset. We have built teams and mentored next level leaders with great work ethics to be awarded with prestigious Hitachi Values in Action Awards. Today, we are honored to have him, and he's going to speak on topic SPAC, which is one of the trending topics in finance. And please make the session as much as interactive. Ask as much as questions you can ask. Put your questions in chat box, Q&A. He'll be answering most of the questions. Over to you, sir.
Hope so, Richard. Thanks for the kind introduction, and welcome everyone. Good evening to this session of Samvaad at Simandhar Education. It's a privilege being on the session, talking to all of you. I can see about close to 26-30 participants already, and I can see people from Vietnam also joining in. So thanks a lot. And I'm here to share my insights on SPAC. I was telling Richa and the team before that I've been an early student on SPACs. This is one of the papers that I'm discussing on as well with my some of the startups here in Singapore. And this is of great interest to me ever since Grab has taken Southeast Asia to a storm with this valuation and its purpose of going public. So what we will do is I have about next about 60 minutes or so. I don't have too many slides. I'll keep about 25 to 30 slides, and the slide deck would be shared across. I've already shared one preliminary version with Richa and the team. So all of you will be getting a email from her most probably after the session, wherein you can have access to this. All of these are public information. I've just collated it and tried to arrange and structure it for the purpose of my narrative. So I would want it to be sincerely very interactive. We are on a Friday evening. Let's make best use of it. So I will also look at the chats, trying to do multitasking. I need Richa's help if there's some question comes in, and if you want to share something, I'll be also requesting inputs from you guys so as to ensure that you're following the session and not just glaring at the screen, right? So let's begin. So what's a SPAC, and any quick thoughts on these four companies that I'm showing? I'm showing a Grab, I'm showing a Lordstown, DraftKings, and UTZ. So any quick chat comments that comes in gets a brownie point from me. What are these companies? How are they connected to SPAC? Has anyone heard about Grab or Lordstown or DraftKings or UTZ? This is the first time you guys are hearing about this. I'm looking forward to the first comment coming in. Okay, so let me give the first one. Thank you. Grab is a logistic company, transport company. Yes, Sumit, Lakshmi, agree. It's a ride-hailing company in Southeast Asia, and they are going public. They're a private limited company right now. They're going public, and there's a case study on Grab that we will discuss towards the later part of it. Lordstown is again an EV electric truck making company. DraftKings is very familiar to our Fantasy 11, the cricket league that we have in India. So it's an online digital gaming, sporting, betting company, which based out of US, it gives an avenue for a lot of the people, close to about 640,000 people on an average every day who are betting on, and this is legalized betting. And UTZ, of course, is an power snacker as it calls itself. Yes, Lakshmi, you're right. So if you look at these four companies, right, and let me just take you a little further into these four companies on the first slide itself. These companies have gone public, and these companies have gone public using SPAC. Now, what is SPAC? This is, of course, I'm not looking at a narrative of the description of the special purpose acquisition companies, but these are companies who are private company who used an shell company or a blank check company to go public. And if you look at the nature of these companies, and just moving on with the next one, right? So these companies are not the so-called Airbnbs or the Ubers or companies whom otherwise we know having high valuation using the SPAC, using the IPO route, because there are only two ways of raising capital in public. One would be a direct listing. I'm sure all of you know this. And the second one is using the bankers for listing this, listing the companies using the S1 route, filing of the red prospectus and all. So if you look at this slide wherein I'm showing Galactic and of course Serena Williams is coming in here. Let me just get it. This Bill Ackman, Virgin Galactic, and Churchill Capital. So continuing with my first slide, if you look at the narrative of all these companies that are being used for the SPAC and the kind of valuation that you're seeing, you will understand that SPAC is a mode that has been used in last 2 years especially. And the reason for that is that these are new age companies. You don't have enough data, enough financials, enough order books for these companies to even go IPO or go through an listing. We all understand that for these companies to go IPO, they would need to put up financial projections. They would need to go through a prospectus road. They would need a merchant banker or investment banker to do a financial due diligence and then do a market intelligence, find out an offer price or a bid price. And that's a long-term process. So one of the reasons that the SPACs have come into a picture and the fact that they have been very popular, the way I've been reading is that the time to market is good and they are not procedurally or administratively very long in terms of the overall period to go public. So what are we signing up for today? So we are looking at the rise of 2020 in the SPAC. Sorry, in the SPAC. What happened in last what about 20 months or so? The history of SPAC, is it a new phenomenon? What exactly goes through the process in SPAC? What is the advantages, disadvantages, the regulations that are there currently? India, a very unique case study in terms of all our offshore regulations that we have and shell company regulation that we have, case study, and given my closing thoughts. So that's currently what I aim to cover right now, and I'm just moving along. So I hope there are no questions so far. Richa, you need to help me with the chat. I don't think
yes, yes, sir. I will.
At the moment I'm clicking, it goes off.
No, sir. I will let you know if there is any questions.
Okay, let me see if I can get the chat in the box. Is this blocking the view?
No.
If I get the chat on the screen?
No, it's not.
Okay, that's good. So let me minimize my screen as well. Good. So if you look at the overall history of SPAC and the rise in 2020, 2021, the reason I'm looking at it 2021 is because while SPACs have been there since 1980s, this is surprising to me as well, because I thought that this is a recent phenomenon given the popularity and the craze. There were a lot of initial financial scams, and then after the GFCs, the global financial crisis, there were a lot of tightening of rules, and SEC came up with more disclosure norms and all, and SPACs was not a great tool for companies to go public. If you can see the table on the right-hand side of the screen, you can see from 2005 to 2021, and this is the data publicly available from, I think this is a website called SPAC listing. And 31st of March 2021, you will see the number of SPAC IPOs versus the total IPOs that have gone in. And just look at from 2018 onwards, the way it has picked up steam, and 2020 and 2021 has broken all kind of shackles, if I could say so. The first SPACs, as I said, came up in 1980s, and then of course the rules and regulations came in therein. And after that, this has never been looked upon as much as it should have got a popularity given all the benefits that we have and the time to market it does. Many VC-backed companies have led ample access to capital. The large venture capital firms like SoftBanks and have given 100 million plus grants to large stage private companies, deferring the need to go public. So one of the reasons that today's SPACs have gained popularity is, of course, 2020 and 2021, the stock markets were all over the place. There were a lot of volatility. I'm talking more from a US perspective. Initially, the COVID impact, the pandemic impact was there. Then the oil prices impact came in. So the stock market was going down. Then the stimulus came in US. Then it again went up. Then the election. So it has been on a very volatile route, if I could say so. And if I was a private company, I didn't have a confidence in terms of what should be the ideal time for me to go public and what should be the price at which I should time the market. I think these were two major concerns which I could also sense for which companies used a separate shell company, and we'll come to what exactly SPAC is and how it was made and all. But the major reason was this. And then there were a lot of private companies which people were eyeing for, and they were looking for investing. The opportunity cost of capital was pretty much in single digits. There were no other investments arenas that people could look at it. And hence something like this, which US is always known to be, whether it is the Bitcoins or the dog coins or whether it was SPAC in this case, came out. And the SPACs boomed up, more than $107 billion in 2021, first 3 months. Of course, as we speak through the slides towards the end of it, I also have the April and May stats, which is showing little contrary views to what otherwise this euphoria shows. So we are seeing a dip in the overall SPACs in April and May, but there are more than 450 SPACs were waiting to be, which are listed waiting to be de-SPAC. Now, what is a de-SPAC? I'll come to that. This is the process wherein they merge to a private company and take the private company public. I'm hoping still no questions therein. So let me just see what's next. Sorry. So what's a SPAC? I think in layman term, it's a shell company which is started off by a founder and a group of promoters or founders who start off with some management expertise, and they say, okay, let's form an initial promoting company, which will have obviously a nominal capital that would be introduced by them, who will be taking their own for that 20% of the overall equity in that company that will not have any assets, no operations, nothing. So this is basically a vehicle which is listed on the NYSE and the NASDAQ. And there are listing norms for this, but since there is no transaction in these companies, the listing becomes very easy. So it's like listing an empty company, right? So listing an empty company will be always easy, because what do you say in that? You only say about, okay, who are the founders, who are the managers, management who are sitting therein, and probably you will also give a detail on the Class A and the Class B shares that is provided therein. There's nothing beyond that you need to provide. And then the remaining 80% interest is held by public shareholders who are given the units offered in an IPO of SPAC shares. These are all at $10, which comes with a warrant. And this, I'm sure all of us understand what a warrant is. It's a option to subscribe to future shares in the new merged companies, right? So it's an automatic call option that is resting on the shareholders who have the right to buy the shares of the merged companies. Founder shares and public shares are generally having similar voting rights, with the exception that founder shares have sole rights to elect the SPAC directors, and warrant holders generally don't have voting rights. So here it starts with the cash that starts off with the initial cash that's been put in. The company is formed, then we get the IPO listing done, whereas enough cash that comes in, and those money is put in a trust, and that's the advantage. One of the advantages of a SPAC, that there is transparency from that part of the overall transaction, that this cash is kept in a trust. There is some interest that is being generated. Of course, currently with interest rates, it's very low, but at least it helps in covering the initial working expenses, founders' expenses, and SPAC management fees and all those stuff. And this cash is held in the trust. Then we find out a target company out there, and then boom, it's like A plus B is equal to C. The listed successor company is the public listed operating company, which comes out of the SPAC. So the SPAC gets dissolved, it gets de-SPAC, and as a result, the new public company comes into existence. I'm just going slow after every slide so that I can see if there are any questions coming on that. this was a nice, I think, pictorial representation thanks to CB Insights. So here is the same thing that I was telling about. The Emma wants to form a SPAC. She launches an M Corp, files to go public, goes to the roadshow to find investors. Now, if you, those who have already been associated with IPOs like we did way back, we were very close to doing that, but couldn't do that as part of my journey in Sierra Atlantic. But they will understand that in terms of an IPO, in the second stage itself, there will be a merchant banker coming in, there'll be an iBanker, and either I go for a direct listing or I go a listing through them, and the entire market intelligence, the timing that takes, that's at least anywhere between 6 to 12 months or even beyond. And in this case, I think this is between 8 to 10 weeks. And that's the biggest advantage of a SPAC. Investors get $10 each. That money is kept in a trust, and it goes public. It's kept in a trust. Then there is about a 15 months to 19 months timeline. Then they decide on a company. Let's say it's startup company, negotiates the acquisition terms. Here, there's one more interesting aspect to SPAC, that the voters, the initial voters or participants to SPAC have a right not to not to agree to the company that is being looked upon to be merged with the SPAC, and they can liquidate their $10, the shares that they have in the SPAC, and they get back the $10. So that's one of the advantages. Of course, the timing, the 2 years of opportunity cost, that is lost, but it is still not an sunk cost from an overall perspective. So shareholders vote and agree to buy the company. If they don't vote, that's what I was telling, that they can liquidate their holdings in the SPAC. M Corp buys the company with money from the IPO and additional funding from the investors. The additional funding is called PIPE. This is more like a private investment, a public investment, private investment in a public equity. So basically, they seek further funding in case the overall fund that is otherwise accumulated at the SPAC is not enough. I see a question. I'll just take it once I finish this slide. Startup merges with M Corp and officially trades on NYSE. So the SPAC goes off, and the startup co, which was a private company, becomes a public company. Okay, so the first question comes from Ashish. What is the perception of the general investors in regards to SPAC? Good question, Ashish. I'll come to that. So how is the risk appetite and how is it being perceived? So interestingly, since you asked the question, there was a study done by Stanford, and they said 85% of the people who are into SPAC are institutional investors. So the retail investors still don't have a great feeling of SPAC because of the fact that this is not meant for the retail investors, because it's a very closed room negotiation, right? So I start as SPAC, then I find out who are the people like-minded, what are the objectives of the SPAC that I go to them. I have to do the sales pitch to get the SPAC to an IPO, and then I need to have people who trust my wisdom. And that's exactly what I'm saying, that in terms of a SPAC, what do the investors seek? They seek what is the target? Is the target business established? What is generating enough cash flow? Is it going to be the future Tesla for them? What is the kind of companies that SPAC would be looking at? What is the timeline? Do we have a target? And what are the competitive advantage? What is the strategy of the company? So these are some of the questions that most of the investors who are part of the initial SPAC listing do ask. So the perception, to answer Ashish's question in this slide itself, the perception is that if I trust the founders of the SPAC, if I trust the management promoters of the SPAC, then it is more comfortable. So it's like, let's say if we talk about Social Capital or Bill Ackman's ventures. So these are all ventures who have taken companies like DraftKings and I think Nikola Motors, Lodestone. Of course, these companies after the SPAC have not been performing well, but at least the SPACs were successful. So if you have a good CV of these companies going public, then the trust levels are high, and you definitely want to invest in it, because there's always a FOMO therein, right? So there is a fear of missing out, saying that, okay, these companies are good, so why I should not miss out on opportunities of investing in this SPAC. The next question is, in your opinion, how many countries and rather which countries would adopt this method? So currently, US has adopted it, UK has adopted it, Singapore is adopting it, and Hong Kong is also adopting it. But only thing is, every country is now looking at what kind of regulations they need to have for the SPACs? What are the disclosure norms? What should be the other norms that they should have? So currently it is open for all the stock exchanges to regulate all the, let's say SEBI in India's case, similarly the tax provisions, which will come to later on for them to regulate. But otherwise, in US, this is been there since 80s, as I said. Currently, it is getting good steam. And US gets a lot of capital attraction as well, because a lot of these new age companies are coming out in US. UK also, there has been some cases where SPACs have come in. I think Luxembourg is attracting a lot of SPAC interest as well. Asia has been slow. And obviously, Asia, the regulations are pretty stringent. If you look at markets like Singapore and Hong Kong, even the Grab SPAC, which is deferred for short term right now, it's also going in US. We'll see with India also, there have been 3 SPACs, if I remember, but all of them are getting listed in US and then coming back to seek companies who will be looking at using the SPAC merge to merge. Okay. What are the red flags? Yes, we will have that advantage, disadvantages coming in this. So this is good. 1 second. Let me just go to this. So just elaborate, and this is more for the notes for all of you who are trying to follow the SPAC in terms of, starts off with the same one person, launches a SPAC, no operational business. The filing is pretty fast and easy. The sponsor goes on a roadshow because there's no merchant banker, there's no investment bankers here. And in a way, this is pretty easy. He has his own selective, he doesn't go and do a public roadshow, if I could say. So they have their own investors who have in the past been associated with them and who in the future they believe would be aligned to the overall purpose of the SPAC. Money raised is put in a blind trust. So that way this is not used up, the money is safe. So as to one of the questions that was asked, the risk part of it, I don't see a risk except that if I have signed up for some units in that SPAC, which is going public, I may only lose out my interest cost for 24 months that they will use to take the SPAC public using a private company vehicle. So otherwise, I don't see any risk therein. And the best part for me is hopefully, and that's a big blind side that I have, that the companies that the SPAC founders go and hunt for, those companies would be companies which will have a higher valuation. And that higher valuation will help us increasing my overall capital value for each of these shares that I'm holding there. So once the SPAC is listed, IPO is there, then this is the process called de-SPAC. There is an 18 to 24 months to identify and complete a merger with a target private company. And these companies, and that's the reason I started off with those 2 slides with Virgin Galactic and DraftKings and Lordstown and all these companies. These are, at least the trend that I have seen, these are all companies who are early age companies, new tech companies, companies who don't have, like, for example, Virgin Galactic, they are charging $250,000, if I'm not mistaken, for a space tour. And they already have more than 700 to 800 customers lined up, but they don't have a single flight taken off yet. They're already valued at more than $2.8 or $3 billion, right? So, and similarly with DraftKings, I don't think you can associate that with an IPO wherein somebody like a betting platform will come and say, look, I have 640,000 people on my platform or subscribers to my platform. They will bet for next 5 years on IPLs. In US, of course, there's no IPL, but let's say for the NFL out there, or maybe to all the premier events, the US Opens and all, and I would have, this is the stream of revenue that I have. You can't project the financial projections for those companies. And that's the reason SPAC has been popular with those companies as well. Even with Grab, I think one of the reasons Grab is going public is because of the urgency using a SPAC model. If today they have to go on an IPO, I don't know if they could get a $39.6 billion of valuation. And one of the tie-ups that they had with Uber as part of the parting in Southeast Asia, Uber had a stake in Grab, but they wanted Grab to go public as well. So the urgency is also creating a lot of reasons for this companies to go use SPAC to go public.
So Sumesh, we have one question on YouTube. The question is, how is SPAC different from the traditional IPOs? I mean, we used to have the IPOs previously. So I think they want to ask a question that how initial public offering is different from the SPAC.
Yeah. Okay. Let's just hold on to that question. I did touch upon that, but I'll again touch upon it in one slide wherein I'm talking about what reverse merger is and what IPOs are and how this is different. I could see one more question about what the India laws and regulations are as well. I'll come to that as well. So quickly on continuing on this is the Form S4. This is mostly in US. And then there is a Form 10, Form 8K. These are all filed in across. And then the SPAC becomes de-SPACed and the company goes public, right? So I think I've already covered. These are the 3 phases, if you look at it. And this phase gives you a timeline indication. 8+ weeks to start with an IPO, counsel, auditors, and these are like pretty easy for an SPAC because for them, it's a shell company. There's nothing. Form S1 filing is pretty easy as compared to an IPO. And just to answer that question, slightly saying that in an IPO case, the S1 would have a lot of financial disclosures, validation. The entire process is pretty long because the financial due diligence is a very, very important part of the IPO, Shripal. So which I'm sure you must be knowing as well. In case of a SPAC, what do I do a diligence for a shell company or a blank check company, right? So the important stage comes in here after the SPAC goes public because I have got some time limit against which I need to ensure that I get the right company. I ensure that the valuations are right. I also ensure that I get enough public investment ready so that whatever is the gap between the SPAC's total funding versus the funding that is needed for taking that company public through a merger, I have enough money therein. And then finally, the closing part of it. So in this entire journey of 24 months, so in 2 years, basically the 2 years is not for a private company to go public, but the 2 years is basically for the SPAC to ensure they are de-SPACed and they help a private company merge out. They help their own investors to encash in terms of finding out that company, the target company, and also taking the target company public. And with the listing of the public company, all these founders and investors of the SPAC, they encash their money as well. I'm just checking out on the questions that are coming in. In India, and so many SPACs are there in India. Okay, that's good. I'll cover that piece. And then there's one thing on chat. Traditional IP, which one is better? Okay, thank you. So let's see a quick walkthrough on the timelines. 19 months, again, just a pictorial view. So it starts off with the formation IPO phase up to 19 months. Investor meeting, shareholders, yes, agreement reached, no, return to target or dissolve. This dissolution is from the trust, the money goes back. Approved chasing of the SPAC merger. This is the de-SPAC. Wind up SPAC return investment. So if nothing happens in this case, target search, there's no consensus that is arrived in, and they don't find out, and which is very rarity. I have not heard a single SPAC which is not yet found. Of course, now there are more than 450 SPACs who are waiting to be de-SPAC, but I have not heard a case wherein a SPAC was opened up and they just dissolved by themselves. Yes, so this is the question that has been there in the chat, and I think Shripal, you also touched upon, right? So quick questions or quick inputs on the chat. How do we see a company going public using IPO? What are the two easy routes, if I could say so? The two modes for companies to go public using an IPO. One, yes, I see one response. Thank you. Let me see. To issue shares, okay. But how do they do that, Lakshmi? Okay. I think in the interest of time, I'll just quickly wind up. So there are two modes. Yeah, there's one more chat that's coming in. To recognize stock exchanges. Okay. So for any private company to go public, first of all, they can do it by themselves. That's called a direct listing model. And a lot of you would have read about it. In this, the companies go by themselves. They don't engage an iBanker, and also these are cases wherein they themselves do the market intelligence, do the price discovery, and they do all the red herring prospectus filing. They do it all by themselves. The other way is they hire an iBanker, and the banker does all the valuation underwriting, and bankers underwrite the price of all these bid prices, which we call for the private company, and say that, okay, this is the price at which we believe that you will have maximum public interested in your shares, right? So this is one of the biggest difference. Sorry, guys, 1 second. This is one of the biggest differences that is there between a SPAC and IPO. In an IPO, a private limited company goes to a bank or by itself directly to the stock exchanges, gives an 5-year projections or a 10-year projections therein, substantiates the valuation model that's been used, work with the bankers, work with the iBankers, and tries to come through a price discovery model in which they decide what should be the price at which it should be going. And the bankers underwrite it. There will be underwriters to it, and they will underwrite the price of it at possibly a discount of 5% or so. So if I am looking at a price of 200, then I'll probably look at somewhere close to about, say, 180 or 185, and that would be the price. And this price is generally kept little low because there is an underwriter who is taking the risk, saying that your shares would be fully subscribed at this price. If the shares are not subscribed at this price, we will pick up the shares, and later on we will discharge our obligations therein. So there is an assurance to it. At the same time, this entire process of going public using an iBanker or going direct listing itself, there is a huge time that is taken in. I think in a SPAC, the biggest advantage is we don't start with a diligence, we don't start with a financial projection, we don't start with an iBanker. We start with a limited set of people. We create a pool, we create a corpus, we go public as a shell company. And as a shell company, I try to get that listed. Listing is very easy because I don't have any data, nothing. I'm listing myself as a shell company. Then I find out a private company. The private company gets merged with me. So that's a big difference if I was able to elaborate. And there is data that's been provided here, right? So compared to traditional IPOs, SPAC IPOs can be significantly quicker due to its lack of fundamental operations. Both the financial statements and prospectus filed during a SPAC IPO are significantly shorter and can be prepared in a matter of weeks. There are no historical financial results to be disclosed or assets to be described, and business risk factors are minimal. Because I don't know, as a SPAC, what do I give a risk? Am I going to merge with an EV company? Am I going to merge with an online betting company? I don't know, because I have not identified. Yes, my investors have a view saying that, okay, the reason why we are starting off this SPAC is in a specific geo or a specific sector, we would want to go and merge and take a company public, and the valuation of that company has to be good because this is a future company in which the investors of the SPAC will monetize their investment. That means the $10 should at least reach to a $17, $18, by which they would have a capital appreciation, or they may even stay longer with that private company which becomes public. I knew this would come in, so I got a slide which covers the complete differences therein. And yes, here it is. I'll just take a quick pause here and wait for any questions on the SPAC and the traditional IPOs.
So Sumesh, we have a question on YouTube. So there are discussion about Walmart's Flipkart going IPO via SPAC route. So why would a Flipkart go on a SPAC route?
I don't know about the IPOs, the Flipkart route of SPAC. I can only say is whatever reasons that we are discussing right now, that is one of the reasons that they're also figuring out that it's easy for them to use a SPAC route. But now Walmart, I don't know if they're willing to go a SPAC route taking Flipkart therein, because there could be a challenge for them because of the fact that Flipkart predominantly is an Indian company, and in India there are rules of swapping and the overall SPAC size and valuations and all those stuff. So I can check on that, but frankly I have not read about this. So if Flipkart and Walmart are going SPAC or taking public using the SPAC route, that could be interesting. There's one question on what's the price of the SPAC. As I said, it's $10, so that's a uniform price. This goes for the listing. And after the listing, the SPAC is like any other company, right? But a shell company, the price may go up and down. I don't think it will have too much of a variance. the purpose of the SPAC price is to ensure that everybody has a nominal price to that unit that they prescribe to. So the $10 doesn't go to 20, does not come to 8. But yeah, there are certain cases wherein probably the credibility of the founder of the SPAC or any of the previous companies that they've taken public, that is not performing. So as a result, that could get discounted at 8 and all. So possibly that could be the only reason that I can think of SPAC getting valued lower. Otherwise, I don't think so. Yes, it's uniform to all companies. So again, a quick recap. So 3 to 4 months, 6 to 9 months, limited interruptions, comprehensive preparation. Now, IPO, I would be really surprised if a company can go IPO in 9 months, especially in a country like ours as well. This will be pretty long. I would invite thoughts on it, saying that, okay, in India, how much time does it take to go public? I would generally feel that anywhere less than a year would be very less, because it's not about going public, but it's also about maintaining your books, records, giving the financial projections, getting an iBanker, auditors. I think the entire pre-IPO preparation, that takes a hell of a time. And that's what I have experienced. Of course, we were not looking at going public in India. Sierra Atlantic was a publicly listed company earlier in, I think, 96 to 99. But when I joined after that, we were looking at going public in US. But then 2007, the GFC happened and we couldn't go public therein. But the entire 2006 was spent on preparing for the S1s and the financial projections and hiring the Big Four auditors, getting the data validated and all. Believe me, if we knew that there's something like a SPAC that was allowed at that time and was equally popular, I'm sure it was allowed because it's been there from 1980s. Possibly we would have used that route, but this was never suggested by anyone. Even our iBank has never suggested that we should take that. So I hope whomsoever had a question on the SPAC versus IPO, this helps. And
now one more question comes on the YouTube, Sumesh sir, on the accounting treatment of SPAC. So do we have any guidance or a standard which talks about SPAC, or
yes.
Is it covered in the business combination?
Yes, so that's a very, very critical question. And today, again, I had one slide which I was missing because I myself could not figure out. The Securities Exchange Commission has come out with a guidance on how do we account for SPAC, especially for the warrants, because they have wanted the warrants to be kept as a liability. I'll touch upon that, Shripan, but currently there is no guidance on it because this is suddenly come up in last 2 years, right? So the way the entire merger would be done, this would be like a business combination. So there's no doubt about it. But the way the SPAC would be valued and the way the warrants would be valued, there is a complete discussion that's going around, and there is a lot of guidance being provided by SEC. India has been very silent because India has only seen about 3 SPACs which are keen on taking companies public. So otherwise, India has been a very silent spectator on this. Our Gujarat, whatever GIFT, right? That is showing some promise, saying that in fact there was an I think ET article which says that the finance ministry is keen on having SPIKE guidelines issued out of GIFT. So probably that could be the beginning of it. But as far as India is concerned, there is no accounting guidelines. In fact, the ICAI also, to my knowledge, has not come up with anything because it's not relevant to us. In US, Security Exchange Commission is issuing some guidelines, and the first guidelines that they've said is how do you value the warrant which is otherwise issued? Because as part of a warrant, what happens is the promoter group or the investors who have this warrant, they can choose or exercise that warrant at a time when they feel that the price of the shares have gone up, and they can choose that at a predetermined price, which will be mostly around $11.50 to $12 against a $10 share. And everybody gets a warrant, right? And they will go and exercise it. So how do you value that difference of the $12.50 to the $18, $20, $25? Do you create an reserve, or that guidelines is still not out? So I don't have an answer to it, and neither I don't think anybody has any written guidelines to it so far, but it is on the works because these are all recent things that's coming in. Good. And Shripal, let me know if there are comments which says that they didn't understand what I was trying to clarify, because the purpose of this is that I am able to answer, or I take back that question. Like the Flipkart question is something that I'll take back. I'll read over the weekend and see if I find some insights to it. and I'll come back to you, and then probably you can put it in the same YouTube channel or in the chats or description or whatever is right.
Yeah, sure.
Thank you. So a lot of us have gone through this and have studied a lot about reverse mergers, right? So if you look at SPAC, I think Shripal was touching about it initially also when we were catching up, saying that this looks like more of an reverse merger itself. It is a kind of a reverse merger, but the only difference is in a reverse merger, the private company merges with a listed empty company. It's not an empty company, but it's a kind of a non-operating public company, let me put it this way. And triggers a traditional IPO, right? The shell is left over with it's like a shadow of the history or the legacy in that public firm, and then the private company just uses that vehicle to go public. In this case, it's not the private company which comes in; it's the SPACs, right? So the SPAC is a shell company, and not the public company is a shell company. SPACs are the first proactive party. They have got the cash from the IPO and the investors. They also go and talk to the pipe investors to create that sales pitch for the SPAC and also the company, and try to go and merge with the private company to take them public. So that's a difference in the role. The parties are the same, but they flip the roles there. So private company, in case of a reverse merger, is more keen on taking the public route, using the public company or the shell public company or non-operating public company. In this case, it's the SPACs because they have that 15 to 24 months of timeline by which they need to ensure that they use the cash that's been there in the SPAC to take a private company public. I didn't know that reverse mergers have gone into a shell right now, because at least as far as I was in India till 2000 and I think 14, 15, I still saw some reverse merger cases happening. But now I believe when I went through and looked at it, especially I'm not sure about the India markets, but in US, the stock market valuations of reverse mergers were pretty negative reports coming in, which discourage overall practice. I am not aware of any rules which today is stopping any reverse merger, but as I mentioned, the SEC rules on disclosures, which comes with a very stern warning, and probably a lot of the Chinese players coming in there and disclosure norms. I think overall SEC is not very positive about it, but happy to hear any thoughts on if you guys have seen any reverse merger in India, which in last probably 24 months. At least to my notice, I have not heard, or it doesn't rhyme a bell in my thoughts. Okay, so this is the, again, a CB Insights slide, very beautifully captured. So what are the benefits for companies? Of course, it's a certainty because as I said, in a volatile market, you don't know what would be the price. You don't have a great market intelligence, the speed, and the partnership. Partnership is basically the management partners who may continue to continue with the merged entity. Benefit for investors, I think the risk is pretty less because the money is in a trust, and it allows them a piece of the pie. Of course, redemption options are there. In 2 years, nothing happens, money gets back to them. And obviously, there's a capital appreciation given the faith and the trust that they have on all these SPAC founders. And I'm not trying to make it easy, but it's not easy for even the SPAC founders to go and create a 200 million, 400 million kind of an SPAC, because it would need a lot of their credibility. Companies like, again, taking the name of Bill Ackman or Social Capital, Chamath Palihapitiya, these guys have got enough credibility backing them, which helps them to take a 4 billion or a 3 billion. Bill Ackman is coming up with a 4 billion SPAC to take a 10% stake in Universal. So the music label, if I could say so, right? So it may sound easy, but it's never easy. But for the investors, there is a risk. But the risk is that for 24 months, I don't have an alternative use of my $10 scripts that I've taken. And I would get back that money if I believe that that company which is being taken public does not have a great future. And that's a risk as well. So if you ask me, I'm again touching upon a very sensitive topic of valuations. Today, I don't see a great model of valuation. When we were all looking at M&As, and including 4 of it that we did, we always looked at discounted cash flows and all. Today, if you look at it, just on the same topic, an Airbnb is valued more than a Marriott, which has got probably $20 billion of property on its balance sheet. And Uber is valued more than any of the other fleet operators that we have. So all these so-called digital companies or new age companies who are today using business model and using digital as a model to create a platform or a marketplace, they've been valued very high. So can I blame a SPAC for that? I don't think I can blame a SPAC, because if these companies are getting the value, I'm sure the future monetization of these companies are far higher than all the brick and mortar companies that we are seeing. So for that, I can't blame a SPAC to that matter. It's a trust that I need to have in that company in future. And if I don't like that company, I still have the option to redeem, right? So moving on to the sponsors, I think, yeah, I mean, they have nothing to lose out except that they always have a gun on the head that in 24 months, they need to find out a company, merge it out. If they don't merge, then they possibly will be on the losing side, because there is a cost of running this SPAC, including whatever the going public on IPOs and whatever minimum disclosure norms and all. They need to engage in auditors. They would need a lot of market roadshows and all. So there will be a loss to these sponsors if they don't find a target company. Good. So just to summarize what we are, I think some of the advantages of SPAC: access to capital when market volatility is there, and lower transaction fees. Of course, the transaction fees are pretty higher after the company goes public and not at the time of going IPO, because as a shell company, you will have very less transaction fee. High incentivization, as I said, the sponsors would need to find a target company, and this could act as a disadvantage as well, right? Because, and that's what is happening with Nikola, that's what is happening with Lordstown, and people are today questioning the valuation of these companies who have used the SPAC model, and they're saying that people are taking the investors for a ride, and that's where SEC has stepped in. I think over last 1 month, the amount of guidelines that has come out of SEC, that itself speaks of the kind of disclosure norms that is expected. But having said so far so good, I think a lot of these companies are timing their public arrivals. I think it's a win-win as long as we find the right companies out there, right? So disadvantages, and I really found this word speculative to be of great interest. I think this is one point that is coming, and we will see that in one of the case studies as well, the lack of diligence. Because what happens is, if I am a SPAC founder, you can understand that in 24 months, I need to take one company which is private, which will have a good valuation. I need to go back and tell my investors and say that, look, this company is good. You need to trust me. We will take this company public and the valuation will go up. Your $10 will become 20 or 25. You will encash it. You can monetize it. And if I have a 3/4 majority, I'll leave the 1/4 to encash it. And I'll anyway have pipe investors. So I am not necessarily dependent on my investors alone. By that time, thanks to my roadshow, I would have had my pipe investors backing me. So pipe investors are basically investors who could be the Goldman Sachs of the world, and they need not be unit holders in the SPAC, but they would want to participate along with the SPAC in merging with that public company for the same interest that they would also want to encash on the ride of that public company once it goes, once it gets listed and once it gets a higher valuation, right? And all the companies, whatever you see and whatever I've shown in the first 2 slides, they've got some phenomenal valuation. All of them range from a 1.6 to 4.5. Grab has been valued at 39.6, but the SPAC value is close to about 2.3 or 2.5 billion. So these valuations are all crazy. As I said in the past also, Grab doesn't own a single car in this region. I don't think, except for UK, none of the Uber drivers are on the payroll. UK, it came out. I think California also is now legislating and making mandatory that these the Uber drivers need to be employees and they cannot be gig economy drivers or on contract employees. So these are all companies which are coming up with a business model, creating a marketplace and getting a very high valuation there, right? So lack of diligence is a huge risk that I see, but if you look at it deep inside, it's a risk that an investor takes based on the SPAC founder. If the SPAC founder's credibility is questionable, then I'll not. If it is not questionable, he's got a good track record, good CV, I'll go and invest. Unknown targets, yes, we don't know what is the company that is going to be merged with, and there's a timeline of only 24 months. Target company's management team will need to focus on being ready. Yeah, this, as I said, the public company, this is more from a public company perspective and not from a SPAC. A lot of you who are working with public companies, you understand that what is the preparedness to be public in terms of having quarterly reports filing, in terms of the financial projections, in terms of your internal audits, controls, SOX compliances in US 401, 402, 410. So all these compliances and audits and financial planning analysis, this is a huge ask on that company. So when a private company is prepping to be public using a SPAC, they need to ensure that they have the right ecosystem and the governance to be public as soon as they become public, because SEC is not going to give them any cooling period. I think they have about 30 days time once they go there. But one of the reasons that today Grab is deferring its SPAC route to go public is because it is preparing its own internal financials and internal audit compliances, controls, and all those stuff. Weak investor protection. This is something that Warren Buffett had come out and spoken against SPAC in one of the last shareholders meeting when he was asked this question. So he said, who does the due diligence? Advisors, brokers, fund managers, they all do it in an IPO, as we discussed a couple of slides earlier. But in case of an SPAC, I don't know. I only know the SPAC founder. So, and the private limited company, it's a private company. A lot of these companies, if you look at the companies that we keep naming, I don't know, without the first flight, Virgin Galactic is public. Without the first car or the first truck, Nikola and Lordstown were all public. So what do we see in these companies? So it's just a future value that we can get in. So there's nothing of the past that we can look at, and there's no historical information available, right? Coming to the regulations, I know I'm hoping to wrap it up in next 10 minutes and then open it up for questions. But feel free to pop in. I think it's not important to walk you through this entire slide deck, but to understand the concept. And as long as we all understand the concept at the end of this meeting, I think I'll be pretty happy with the outcome then. So regulations, this is completely US markets. As I said, a lot of new disclosures are coming in. There are two basic regulations that is required, that the market value of the private company, which is getting, should be 100 million, and the market value of the publicly held shares should be at least 80 million. NASDAQ is 75 and 50. So that's not a big requirement at the same time. An IPO bid price should be $1.04 at the time of initial listing. So, and this is all from an SEC listing. As I said, I did read somewhere that SEBI is planning to come out with SPAC guidelines, but I have not heard anything as of now in India. If any one of you is aware of something that's already been planned for in India, would be happy to get that insights and also look through it. Till today morning, I've not read much about either this SGX, the Singapore Stock Exchange, or even in India as well. Singapore Stock Exchange is preparing right now. There is a white paper in circulation, and some of my colleagues have shared that they are looking at an overall size of close to 300 million as compared to 150 million here. But we have to see how it evolves in and what are the other disclosure norms and all. SEC of late has come up with a host of compensation arrangements and conflicts of interest, share warrant valuations, investment allocation. So because of the fact that 2020 and 2021, more than $400 billion of public money, or let's say institutional money, is already there in the SPACs, the SEC has finally woken up and they want to ensure that it's not a bubble, it's not a sham, and there are enough regulations in place to warn the investors, at the same time to also ensure there's a checkbox and a checklist. Good. So this was a question that was asked in the chat earlier, and this is about India. As I said, I've just taken an EY report, which was there a few weeks back, where an EY was talking about how India can regulate some of these. But if you ask me, India is a great market. There are more than 50,000 startups as we speak. and 45 and more are unicorns, including the recent ones of Credas and Zerodhas and all. And there could be a huge potential for a lot of companies to use that route, the SPAC route therein, but there are restrictions therein. De-SPACing alternatives may create taxable events. I think our tax laws are still not amenable to the kind of swapping that is otherwise expected in case of a SPAC that we saw earlier. I just take this question on chat. Tax is very high, yeah. Acquisition, no, it's not industry specific, Arun. So there is no industry specific as such. So SPACs are like a blank check. You can go and take any companies therein. But the important part therein is that the finance minister, I think in the last budget, did promise to relax a lot of the foreign investment rules and SPAC norms as well, because this was catching up therein. The rules aimed, unfortunately for us, the foreign investment rules, offshore entities, Mauritius, and a lot of the tax litigation post Vodafone. This has now created some kind of an, what do you say, a non encouragement to shell companies and all. So I don't think India will ever open up for SPACs, frankly. And even if it opens up, it has to see how it treats the taxation of all these, the SPACing event, right? So just to give an example, let's say there's a US SPAC or a Cayman Islands SPAC. Cayman Islands is popular in India, right? And there is an Indian company which wants to use that. When the Indian company is merged with that SPAC, what happens? What will be the swapping doing? The Indian shareholders don't get any cash and all, but automatically the valuation goes up. So in that case, will there be a capital gain? As per the rules, there should be. But what do I pay capital gains on? I've not got any cash there. It's just that my company has become public, and it has become public by being listed somewhere outside. I was an Indian company. So these are some of the challenges that we will have from a legislative perspective. I think RBI approvals would be needed in terms of holding any shares or investments beyond 250K. So whether it is institutional investors, they would need to have their own diligence done. I think our capital control rules are pretty stringent. So I don't expect SPACs to boom up in India. There is one interesting one which I have been watching, which is the Renew Energy one, which will be going for an 8 billion SPAC very soon as we speak. But we will see how it works out, right? Yes, so I know, I'm sorry, I'm just probably winding up in next 10 minutes, but this is interesting. I've been following him for probably last 2 months. Chamath Pahilapatia, he was one of the first SPAC kings. He's the guy who took Virgin Galactic. Very interesting case study, a Sri Lankan who joined Facebook and then started off his own venture, social capital. He has already bagged Slack. Slack is a messaging, is an intra-office messaging app. And he's been also keen on Bitcoin. He has been in the news for wrong reasons in the recent past, because he was stopped from trading on the Robinhood platform about a month before or so, when the entire short selling went for a toss. And as a person, he believes that whether the world believes in my SPAC or whether the world believes in my target companies or not, I need to be aligned to what I want to do, and that's only me. So reason why I put in here is when people talk about SPAC, his name and Bill Ackman's name, they do come in a lot. And these guys have actually created a lot of wealth, created a lot of values. He is looking at 26 deals right now. He's already raised more than 4 billion. I think his overall valuation today will be close to 10 billion. Yeah, towards the ending part of the slides, these are the case studies, Nikola Motor. And again, it was an EV. So most of you who have heard Tesla would also be knowing about Nikola. So they debuted on the NASDAQ using an SPAC. Look at the valuation of 3.3 billion and then look at what happened, right? So this is what the diligence and all the shortcuts, which has gotten possibly a downfall happens. So these guys, after going public, there was an acquisition of a fraud, and there was a resignation of the company's founder, and entire valuation went for a toss. Of course, the company is still existing, and they have reduced a lot of their valuation, but This is a classic case wherein if the financials and the credentials are not great, if the due diligence does not happen well, possibly that won't be a great case study under SPAC as well. So I don't know how much of this you can blame on SPAC, but Shripal, I hope we are good with another 5 to 10 minutes.
Yes, sir. That's not an issue. We can.
Okay. Thanks, Rija.
Yes, sir. Yes, sir.
Yeah, thanks. Sorry, I think I should have wrapped it up a little earlier. So Grab I already covered. So as I said, 4 billion, 39.6. In the interest of time, this is being deferred. Again, one of the reasons, as I said, they are not ready when they looked at it. And at the same time, they also wanted to ensure that the audits of the fiscal years 18, 19, 20 are all done. SEC requirements have now come in. Road ahead. Now, what do we see for SPACs, right? So this is what I was saying, that a lot of the SPAC performance have faltered in the market. April and May have seen probably the weakest SPACs that have monetized over last 20 months. The SPAC 50 index have also shown that the overall there's a slump by 4% year to date. All the 21 gains have gone. So there is some kind of an alertness that's been created in the market, and a lot of people who are going behind this on a blind check or a blind date kind of thing, they have now been vigilanted. Is this a bubble? I personally don't see so, because yeah, if you ask me, this is a good vehicle, but only thing is we don't want cases like Nikola's or cases like Lordstown and where the valuations have been wrong or has been way high. We would want proper guardrails to be provided therein. We would ensure that the regulations in each of the domain will cover or protect the interests of the investors. And as I said, on April 12th, there was an accounting guidance that came in. So to answer your point, Shripal, this is only in US, and warrants issued as part of SPAC should be a liability and not an equity instruments. This may lead to a tidal wave of financial restatements. They've also issued equity notices to Wall Street. Nikola has served subpoenas and examination of disclosure. So this basically shows that SEC has woken up finally. If you look at the values at stake and the number of SPACs that has come out, I will not be surprised if there will be increasing regulations that come in on disclosure norms and conflict of interest and things like that. Closing thoughts, given the model and timelines, we may see some crazy valuation. That's concerning. There's a cheap liquidity and very few companies to buy. SPACs 24-month limitation is a huge concern that I see. There will be a rush and desperation. At some point of time, they may outbid the private equity and even traditional synergistic buyers as well. SPACs will start merging with completely crazy companies. Nikola is one of the case. And there's a nice HBR article which came out in February 21, which says that this is a bubble and this will burst very soon. So, and while we speak, BuzzFeed is going public using a SPAC model, right? So the SPAC is an 890 Fifth Avenue Partners Inc. So as I said, as long as these are innovative vehicles for companies to go public, and the risk element to the extent it's known, I think companies will continue to use it. But otherwise, I don't think the SPAC would be a burst, and this will be some kind of an bubble in long term. So with that, I'm sorry I took probably 10 minutes more, but I'm happy to clarify any questions. I have a couple of more slides, but that can be appendix. I've just shared which are the SPAC performers post-mergers, YTD June, who are the top performers, who are the bottom ones. But this can be part of the slide deck that can be shared across. Over to you, Richa. What are your thoughts on the future of SPAC and IPO routes?
Thank you, sir. It was such an insightful session, though I don't know much about SPAC, but yeah, after the session, I came to know so much about SPAC, how it works, what are the advantages, disadvantages. So now we are open for questions. If anyone have questions, they can put up in chat box or raise their hand. I can unmute some of you for your questions.
I would love to hear some voices. So yeah. I'll take this first one from Mohammed Rashid. I think I just shared my thoughts on SPAC. IPO routes will continue. This has been the long tested model. Today, if you ask me if wherever I join, if I join a matured company, a company which has got very strong credentials and wants to go public, I would definitely suggest an IPO route, unless until there is a time factor therein. If there's a time factor, I'll definitely use SPAC. But at the same time, Rashid, if I happen to be the finance leader for a startup and which wants to go public, and if I know the SPAC, like an altimeter in Southeast Asia who are taking Grab public, I won't mind a SPAC route as well. So I don't think necessarily these are bubbles, but I completely agree with the views that these can be regulated. There has to be more disclosure norms. There will be more guardrails. There has to be a lot of, I think, checks and balances on the sponsors in terms of what should be their incentives out there. It should not be beyond that 20%. That 20% post-merger, what should be the value? How can they exit? And a lot of those guidelines is something that I would be definitely expecting. Wow, that's a good one. Ashish. I think Singapore has been a very, again, Ashish, I have to give you this from two, I have to give you an opinion from two angles. One is the current scheme of things. Currently, there is no opportunities because of COVID. Singapore has closed the doors for all the professionals. Work permits are not being issued. So any company which may want to hire you also cannot hire you because the Ministry of Manpower does not give you an work permit. So, but this is only short term, right? So I've been here 5 years. I've seen the market. If you are into the investment banking, BFSI verticals and all, this is probably the best place to be in. I think there's a huge demand for financial professionals. Only thing is, Singapore is in that protectionist environment right now because of the, as I said, the work permit regime. So there is a quota. So if they hire any one foreigner, they need to have 4 or 5 locals hired therein. So unless until you are a king in your own area, you're an SME, you're a subject matter expert, companies are dying to get you on board, you'll definitely be wanted. But at the same time, today the world is looking at countries like India from an offshoring. The industry that I belong in, we believe in complete offshoring. More than 80% of our resources are always offshore. The talent is in India, the skills are in India, and with the kind of dollar to rupee parity that we have been enjoying, I think offshoring would continue for some time unless the labor arbitrage goes off or the skill arbitrage goes off.
Yep. Any more questions? So, like you said that in SPAC, we have a SPAC, the companies get public in a short span of time as compared to IPO. But this can be a disadvantage also because to get the companies in short span of time, sometimes the investors can get into with a wrong company. So this can be a disadvantage as well, right?
Yeah, I mean, the disadvantage would be more from that company, the private company, about the readiness. Right. As I said, Grab is now delaying its SPAC, and I also mentioned about the financial diligence, the ability to churn out reports, quarterly publishing of financials. You look at any listed company. If you're a private company, you should be able to do what an Infosys does or an HCL does or a Wipro does, right? Quarterly publishing results, your minutes of the meeting, your compliances, internal control. In US, you need to have SOX compliances. Yeah. So like as part of Hitachi, we had Japanese SOX and US SOX. So these are very, very stringent internal control compliance requirements that needs to be documented. And you have to show the evidence of these as part of audits. And these audits are done by credible firms, right? So it's not easy to your answer, to your question, for that private company to be ready to go public. But that is the problem for that private company, not for that SPAC. When the private company and SPAC are having the discussion, I'm sure one of the first pointers would be that, are you ready to be merged to go public? Okay. So if they are ready, they are in the preparation, they're only looking at a vehicle, then it works well. Otherwise, IPO works well because you know the road, you know this will take time, bankers will go, there will be a valuation, there will be a diligence. You give a 5-year projection, you look at the last 10 years, there's n number of paperwork that needs to be done, and in that process you also get ready for the public.
Right. Okay. Yeah.
Sumesh sir, I have a question.
Please.
Typically, how about investing in SPACs once they are listed? Because I see the return is almost to 2 to 3%. I was just checking it and researching about. So, as in people, investors, so can they invest in SPAC companies once they list? Because
Okay.
in IPO, not many will get allotment or also. So once they get listed,
once
what
a
is
company, no, that's a great question, Shripal. So once a company is merged with a SPAC, the SPAC dies, then the private company becomes a public company. And then it's like any other public company wherein you may want to invest there. So SPAC's life is only till that 24th month.
Why is that, Sumesh sir, once they got listed? So as I know, the concept of SPAC is very quite evident why it's growing in pandemic time, because there's so much of money printing going on. So people are going on an IPO or on a SPAC route, raising the money and finding out the target. And once they kind of acquire that company, the SPAC goes out, and that's how the companies get listed.
So it's a merger, right? So there is a company A, which is a SPAC, and then there's a private company, which is B. So the B merges with A, and the resultant company becomes a B.
Correct. So now when the B is listed, so why is that? I mean, I'm just seeing the historical returns. So this have happened. So the model is like from 2019. Once these companies got listed, the return, what I see, the people who are investing in these stocks, it has not been over 2 to 3%. So are you seeing that will repeat, or is it not worthwhile enough to invest in these companies once they kind of get merged and get listed, and then subsequently you don't find any returns in the secondary market now?
Yeah, so no, that's a great question. So 9 years, and this is again come out with an, I think a report that came up. I don't know if it was some institute did that. You can Google up. Over a period of 9 years, SPACs have given a 9% interest, 9% return on every investment. But if you look at a short term, right? So if you look at the cases that I highlighted, if you look at a Nikola, now Nikola was, I think it started off at what, $20 or something, went up to $64, the share price, and then immediately crashed. They crashed because there was a fraud. They were promising electric vehicles without the right technology, or basically by showing up an ad which was actually not an electric vehicle and things like that. Unfortunately, and I don't blame SPAC for it, it's a company that has not been transparent, the company whose due diligence have not been great. Lordstown is one more company, right? The EV truck company, the CFO and CEOs have resigned now. They don't have cash. They're on the level of bankruptcy. General Motors have got a stake in that company. Now, do I blame the SPAC which has taken Lordstown to public, or do I blame Lordstown itself? Yeah, you can say when the SPAC was merging Lordstown to take them private, the diligence could have been much more comprehensive. It should have been more robust and all. But the unfortunate reality is these are like short-term gain, right? So people want to merge in that 24-month cycle so that we take the company public, we have a good ROI on the $10 stock, which raises, and after that, it's just left in the lurch. And that's where SEC is now coming up and saying, we need more disclosure norms. So and I think somebody is putting up in a chat as well, there are no major legal boundaries of SPAC. The only legal boundaries is that the SPAC has to be in the same jurisdiction, although there are a lot of US-based SPACs which are outside US also allowed to be listed in US. So the legal boundaries, if you are looking at from a geography perspective, I don't think there's any geographical restriction. But yes, if you look at an Indian company, I don't think, and I'll be very keenly watching that space for the Indian SPAC as well, that if they use the US SPAC or a Cayman Islands SPAC, how do they get treated from a taxation in the hands of the individual investors? That we may have to look at it, but otherwise there is no legal boundaries. So coming to your point, Shripal, I can't blame a SPAC. I can only blame the company in which I invested. So if the company was not credible, if the company has not given, but 2 to 3% returns is lower, probably in a shorter time span it's 2 to 3%. If you Google up, you can see that over last 9 to 10 years, the return on de-SPAC companies or companies which have used SPAC as a model to go public, returns have been close to 9%. So that way it's not bad. 9% is not a bad return considering that it's a 9-year journey. And to be frank, a lot of these are institutional investors. They're not retail investors. As I said, all your Goldman Sachs and huge investment banks, they are investing in these SPACs. So for them, they don't look at a long-term association. They will only look at a short-term gain and then come out unless until they see a promise in the future of that organization.
Okay. Okay. Okay, Richa, do you have any further questions?
No, sir, I cannot see any questions.
What we can do is you can also take up questions from your own students, and I'll be happy to answer. That would be
one last question we can
please
take if you want, Sumit sir.
Yeah, I can take. It's come from Harsh. I can see. After the investors have invested $10 for say one share, then in how much time SPAC has to find the current target, or is there any time defined? That's 24 months, Harsh. So from the date of the IPO or the day that so that's 24 months. Thanks. That's a max. It doesn't mean that we have to spend 24 months. It can be 1 month to 24 months from the day that SPAC goes public. But to the point that I was saying, Shripal and Richa, if there are any questions that comes out outside this, happy to answer this or get the answers because that's a good learning for me also. And look forward to clarify any of those doubts from the slide, from the text. I'll send you the slide. Okay. There are a lot of commentaries on these slides also. So and please don't post any of these slides, at least on the social media. None of these are my creation. These are all like, I have put it up from different sources. I've tried to put the name of the sources like EY, PwC, and I think CB Insights. So these are all based on whatever reading material that I had collated. And frankly, this is a preparation for my own paper that I need to submit. So don't put up these slides on the social media, but otherwise I'm good. You can use it for your own academic interest. You can have follow-up sessions. Happy to be part of those. And thank you. I can still see 25 people on a Friday evening, and it's been amazing. Thank you for being a great audience. Some good questions. Flipkart is a good one, which I need to do my own homework and come back to Shripal and Richa. I'll check on that and come back. That will be very interesting to see as well. But do watch out for Grab and Definitive Energy and some of these companies in SPAC. I personally believe SPACs are here to stay. So I don't think it's a bubble which will burst unless until there are no guardrails, and which I don't think, which is already the past. So there'll be good companies. Good companies will use SPAC as a route to go public, and there'll be a lot of wealth maximization and creation is what I think. Thank you.
Thank you, sir. Thank you so much for taking out time and having this session for us. So this is a very insightful session. We get to know a lot about SPAC, and I will surely get in touch with you with some questions and further sessions. Shripal sir, any thoughts?
I mean, it was an amazing session. So, just to summarize, guys, SPAC is a very, very hot topic, which had been discussed by Sumesh sir. It's a very easy term to understand, but can be really difficult if you haven't followed the session. And with the examples what Sumesh sir have put into it, it really made the things easier, right? So you just kind of find out that you go into the market, take out the money from the investors, and then pump in 24 months, try to find out that target money. And that's where it is a blank check kind of thing, because the investors also don't know where the SPAC would invest or where they will capture that target company. So that's the kind of things which we have discussed, and these are emerging topics. And I'm very excited to understand the accounting impact. Being in financial accounting is my favorite subject, and that's what I teach at Simandhar. And I think I'd be very curious to understand how the accounting implications are, especially for warrants. So I am on my research after this session, Sumesh sir. So straight away I'd be reading books on how the accounting impact is on SPACs, and especially the segment reporting, the various things which are coming up now. And I think these are certain things which we will take out. And I think Richa also can put up some of can mail you the questions which will be asked after the session to us, and we could then email you and get the answers for that. Once again, thank you so much. Thank you so much, Sumesh sir. It was a fantastic session. I'm in US, so I just woke up early morning and kind of got it into the session. So thank you so much. God. The time was worth.
No, appreciate all the support. Thanks to Richa, your team, and Shripal. Thank you for waking up so early for a session which hopefully gives a lot of insights to you guys. As I said, we have just scratched the top of an iceberg. There is lots more to come in this, and keep your inquisitiveness open. Do share all the questions. Let's keep learning from each other. So that's what I've been doing from each of the sessions. Like today, I have to go back and learn the Flipkart and Walmart model, right? So that's my homework that I'm taking off. And Shripal, yeah, accounting entries, would love to see how the warrants. This is the first time somebody is telling me warrants need to be a liability. So I need to see that it's not an equity, it's a liability. So I will also look forward to some guidance that comes up with ICA will be difficult, but SEC would be first. So look out for.
So it has always been the case, Sumesh sir. It has always been the case that our institute it is always a lender to last resort, right? So once the standards come and then we kind of implement. So that's how it have been for cryptos. AICP has been little vigilant in the way they have been coming up with the way they account for cryptos and the technological stuff. I think I'm very confident that AICP and SSC will come out on the detailed guidance on how do we recognize in SPACs. But still, I'll try to search some research materials with the Big Fours on how they are trying to see, because there's a lot of uncertainty on this, and it would be a great research, at least from my end.
Okay, thank you. Stay healthy and take care of yourself. Have a lovely weekend ahead, and enjoy the space and keep your learning curves up. So absolute pleasure being here. Thank you for this wonderful opportunity. Look forward to being
so much,
on more sessions at Samvaad. Thank you, Shripal. Thanks, Richa.
Thank you, sir.
Thank you.